In past talks, we talked about how credit was essentially like gravity, or in other terms, people will say it's the lifeblood of the economy. So, what's interesting here is there's really two parts of that. There is the cost of credit, and then there is the availability of credit, liquidity. So, the Fed last week lowered interest rates 50 basis points. So, essentially, what they did is they brought the cost of capital down. But here's the trick: liquidity is still very dry, and you can see this in terms of overnight interrate bank transactions, essentially where banks put their funds overnight to earn. That is very low, which essentially tells you there's low bank liquidity in the market. That being said, as interest rates come down and people get more secure and deposits go up at institutions, liquidity will go up, and then and people will start borrowing. But again, the idea here is that part of what they've done is brought the cost of credit down, but the other part, liquidity, is still very dry. And it's not appropriate to go to super interest rate sensitive things like real estate quite yet. You need to have some patience as an investor. It really, the right time really depends on, you still need to be in a defensive position at this point. Typically, we need to see if there's a recession or if this soft landing kind of plays out. If I was a betting man, I wouldn't bet on the soft landing. It never seems to play out. And part of that is because of the way the Fed works. They have a really blunt mechanism to do these things. And soft landings need nuance, plus the timing has to be right. They never get this right. A soft landing's only happened one time in history. So if I was a betting man, I would bet more on the probable outcome being some sort of recession. How deep, I don't know. But that's what we're seeing. So what happens is after they cut, you tend to see equity markets sell off. And we're just waiting for that. You see the curve kind of normalize. That happened. And then equity markets will sell off as the reality of the economic starts coming in. So essentially, the Fed going 50 basis points scares us because essentially they're seeing slowdown coming, a bigger slowdown than they expected, or else they would have gone 25. And so to us, that just means the economic numbers are about to get really bad. And so that suggests that, especially when you're hearing them talking about doing another 50 points at the next meeting, it just suggests that we see a recession coming. Now, people think recessions are bad. And yes, they're not the funnest things to go through, but they're very good in terms of cleansing the economy, getting rid of a lot of dead wood. And so I'm happy to see one. We haven't seen one in a really long time. It's going to be a good cleansing of the economy here. Again, we're end of cycle, credit cycle. Essentially, the credit cycle was so long this time. There's a lot of excess stuff out there. So the blow off period is just going to be a little bit longer than typical. The opportunities will come. Okay. There's some good opportunities in the bond market that you still haven't missed out. But the opportunities in the equity, I see a lot of people going risk on, essentially going into the equity markets, suggesting that everything is good, free and clear. We see the valuations there as high. And again, just seeing what's going on with bank liquidity, problem loans, bankruptcies, I just suggest it's probably not the moment to go risk on. Now, that moment will come, and it's not too far off now, but it's just not here yet. And smart investors really need to remain a little bit patient here and let things play out versus trying to run jump the gamut and get in too quickly. You can get hurt that way. And if you ran back into the real estate market thinking that valuations were cheap, there was another leg down and you lost a lot of money then. So again, preaching patience, just these things aren't fast. Cycle changes aren't something that happen overnight. And so again, being prudent, you take your time. You're not going to miss anything. You got to put the fear of missing out on the back burner. You're not going to miss out. You can be very patient at this point in time and still make a lot of money. Still heavy bonds, heavy gold. Again, gold seems to be, you wouldn't think so at this point with some liquidity washed out, but the government debt is somewhat of an issue. So we're having this cross current, essentially. Government receipts versus what you call costs to pay for the debt are getting tighter, and that's going to become more of an issue going forward. Right now, we see deflation coming, but we think that in the next 6 years, there's going to be a couple inflation scares as you have this cross current of too much government debt. And really, depending on what the next administration does, if they just keep on running the debt up, that's going to be a huge problem for the markets to overcome. It's funny you asked that. We like Chinese markets. Not everything in the Chinese markets. We're very picky and choosy what we're buying there, but the Chinese markets seem to be severely beaten up over. Essentially, markets go too far one way or too far the other, and so it looks like the Chinese market has been taken down too far, where I can buy companies that have solid cash flows at relatively low valuations. And so we like that market. We're cautious. I wouldn't go bet my whole everything I own, but we're cautious of it. But we think there's some good opportunity there as well. Further down the road, there might be some opportunity in mining. It's just not quite there. We don't think there's a super cycle in commodities at this point, so the returns will be a little bit more muted than suggested in history, the recent history of those markets. Yeah, so geopolitically, the world is a mess. Geopolitically, the world is a mess. The administration has done things. Probably the worst thing the administration has done is weaponize the dollar. That's not good. That's going to have long-term ramifications. The petrodollar not and that Saudi agreement not being redone is also problematic in terms of dollar being the world reserve currency going forward. And you're seeing SWIFT move quickly, BRICS move quickly. So everybody looks back at the pound sterling as like how long these things take to really work out. We think that's going to be quicker than it did, but it's still over a long period of time, like 25 years versus 50. But the dollar is going to be weakened from a reserve currency status because of what they've done in essentially weaponizing it. So that's probably the one thing the administration did that I feel like is the worst thing that could have been one of the worst outcomes. But geopolitically, Ukraine, Israel, Taiwan, there's just so many different things going on at the same time that poses a problem if, say, Russia or Ukraine starts sending missiles deep into Russia and then they respond with a small tactical nuke or something like that. It's real probability. And then what happens with NATO countries, and do we end up in World War III? That has big ramifications for markets. And yeah, there's always that fat tail, that black swan event that can really disrupt things. About the unrealized gains most people have in their house. Now, the thought is that, oh, it's only people that make $1 million and above. But if you start looking at what's that mean? If I have an unrealized gain of $1 million in my house, did I make $1 million that year? And I have to come up with $250,000 in cash to give the IRS. It's convoluted. But I bet from our speculation, it encompasses more people than the soundbite tends to say. So process is interesting because we are very process driven. And if you talk to a lot of people that do this, we're in a very sweet spot where we are macroeconomic down. So we're looking at the macro environment to pick and choose where we should be going in terms of asset mix, diversification. And then we're quantitative back up. That means we're looking at those areas through numbers using quantitative research. A little bit of art to know where essentially the value traps are and what not to do and that kind of thing. And then, which in end is really repeatable because it's the macro and credit cycles are really important. So in a credit cycle, depending on where you are in the credit cycle, will essentially define what asset diversification you should have. And so it's really important to know where you are in that credit cycle at all times, because that really defines that asset allocation, which is where essentially most people get 60 to 80% of the return. If we look at us, we get probably about 65% of the return just from the allocation. And so that's really important. And so we use the macro research to figure that out. And then quantitatively, we always can put a valuation on the market quantitatively. And so that helps us define, hey, we like equities, but then we'll quantitatively look at markets and say, okay, this market's overvalued or this one's undervalued. And that will dictate where we go with that part of the investment. Really repeatable, highly disciplined. There's lots of times where you want to drop your discipline and chase things. You have to be careful of that because that's how you lose a lot of money. But so highly repeatable, disciplined approach to this. And again, we've been in business since 1999. And again, we make a lot of money by avoiding the pitfalls, not so much catching all the right markets at the right time. It's about avoiding the blowups so that you keep your base high and so you don't have any massive drawdowns is really what we're after and what we've been able to do. How do you save the day with asset management? So, active management. Okay, I got it here. So, why is active management so important? Okay. Again, that macroeconomic part really defines where you are in the credit cycle. So, what we're seeing right now is that there's a lot of people who are pitching passive indexes. Okay. And there's a reason for this that over the last, since 2013, we've had this expansionary market in credit terms, and it's the largest expansion you've ever seen. And it's been low vol. So passive indexing in a low vol expansionary market works wonderfully. It works great. What you get is this bias. It's actually a gambler's bias. Like what you think is that because it's worked so well, that it'll work so well in the future. But we're at end of cycle here, not beginning. And so we're about to go into a new credit cycle. And most indications suggest that credit cycle is not going to be the longest in history like we saw. It might be have some legs to it depending. But there's different cross currents going on, like too much government debt in trading nations. And so what you get is active management will come back into vogue as these things happen. And it's really important that you get those allocations. Being static in your allocations, essentially set it and forget it, 60/40, 80/20, whatever the market wants to throw at you, using index on for the equity side and index for the bond side, which never works. You're going to run into problems as the markets get high, have a much higher level of volatility, and you have cross currents going in all the time. And so what we think is active management, changing your stance based on where we are in that credit cycle is going to be hugely important over the next 10 years. And again, if you're indexing over the next 10, you might get an okay return, but it's going to be muted versus somebody who's actively moving around and catching the allocation correctly. Okay. So what's interesting about indexing? Okay. So we're talking about indexing. Indexing, you need a high liquid market for it to work very well, i.e. S&P 500. Passively indexing into the S&P 500 is easy because you have lots of shares trading all the time. It's very liquid. So you can do that. When we start talking about corporate bonds or muni bonds or any kind of bonds except treasuries, treasury market's fairly liquid. You can actually index into the treasury market. What happens is we're still an old school business. We're still talking to brokers on the phone. People still make inventories of bonds. And so you have essentially lack of liquidity. And so if I try to passively index something that has low liquidity, you have a problem with what they call your creation and redemption units in an ETF. And so essentially, that's why an active manager in that field will always outperform the passive. Because what happens in those bond funds, especially the corporate ones, is a passive bond fund will end up buying bonds of the largest issuers on Wall Street. So because they need to be able to repeat their indexing process. That's a problem because if you think about it, who are the biggest bond issuers? They're banks, there are utilities like AT&T and T and Verizon. So your bond fund will be made up of mainly bank debt and Verizon and AT&T debt because they can rapidly repeat that in the processing. Now, if you think about that from any perspective, maybe those are decent businesses, but they're large debtors where an active manager is going to go in and buy smaller pieces of debt, maybe that are high quality, more high quality than the rating agencies are looking at them because they're too small for the rating agencies to get in there. And so what happens is in typically an active manager in that sector, and I say typically because there's not that many active managers out there, will outperform the passive index. You don't even have to be, honestly, you don't even have to be very good bond picker to do that. And you can outperform that indice fairly easy. That's a real big problem. So if you're looking at your portfolio and that you have some kind of corporate bond index, that's a flag that whoever's managing that for you really doesn't understand that sector very well. And so you need to go talk to them and say, look, I want an active manager here, not a passive manager. Yeah. So especially in that corporate world. So the idea that there's some idea right now where you can stretch for yield in the higher curves. When I say a higher curve, essentially lower debt quality curves, people that are at higher risk of defaulting. But if you're going to do that, you better not have an ETF that holds a million different things because there's defaults in there. You need to be very picky and choosy, or have a manager who's very picky and choosy about what he's doing in there to avoid those defaults, because those defaults are coming. We're in that part of the cycle where we're going to see bankruptcies. And if you look at the bankruptcies just off the top of my head, I can name three or four that are going on right now. And so that's where we are at. And again, we're in a position where going forward, being very cautious and active is going to reward you very good returns. Now, if we were back in 2010, we would go a different route at this point. We would be very passively oriented and just riding the index up as things have been low vol and credit expansionary. It's very no-brainer thing to do. In fact, we started running maybe 10 years ago, the top 10 names in the S&P 500, just those names because of the indexing effect of those names, which is another huge problem going on in the market. You have this massive concentration in the top 10 names of the S&P 500, not just in the S&P 500 indexes, but in every index that is essentially equity derived. They have an over concentration to these securities. If the market does sell off, that we think those securities will sell off has nothing to do with fundamentals of those businesses. They just will sell off faster as people sell the indexes out. And again, it's a problem that we haven't really seen before in the markets, is this concentration risk in these type of products, ETF products. No, I got to jump. I got to go someplace else, but hopefully you got something. Again, I don't, it doesn't need to be long. I just need some snippets. Yeah. Like I said, here's one for you. Here's a snippet for you. And then we'll call it good. You ready? You ready? I don't know. You tell me. I just see my face. Yeah. Because that's how I have it set up. So here's the snippet. Okay. If I was a gambling man, I would gamble on the fact that a recession is more probable than a soft landing. There you go. Let me find out. Let me get out of here. 99% uploaded. All right. I hope you got some good stuff. I don't know. You get what I'm saying, right? One, I can't stand that Farther keeps on telling me that we're going to have a soft landing. These idiots at Farther keep on telling me that I should be investing in real estate and banks. They're nuts. Are you there?